Welcome to this explainer. Okay, today we're diving straight into a super fascinating financial case study to see exactly what makes a resilient Sharia-compliant stock tick. We're going to unpack the data, look right under the hood at the numbers, and figure out the exact anatomy of a highly successful asset. Let's dive in. So here's the core mystery we're trying to solve today. What makes an everyday agri-food business, specifically an egg and surimi manufacturer, a powerhouse Sharia-compliant investment? I mean, why on earth does a company making such basic, everyday consumer goods trade at a premium valuation? Is it really worth the hype? And maybe more importantly, how does it act like a shield against economic uncertainty? Here's our roadmap for today. First, we'll meet QL Resources Berhad, track its share price, decode those key financial ratios, zoom out to look at the macro factors, and finally, deliver our investment verdict. All right, part 1, meet QL Resources Berhad, the Sharia compliance contender. Now, QL Resources is officially listed as a Sharia compliant security by the Securities Commission Malaysia. For Muslim investors, or really anyone hunting for ethical investments, this is a massive green flag. It basically means the core business entirely avoids prohibited elements like riba, usury, as well as gharar and maisar, which means uncertainty and gambling. It's essentially long-term growth potential wrapped in strict ethical compliance. But listen, they aren't just a one-trick pony, not at all. Their operations are incredibly diversified across livestock farming, marine products, and palm oil activities. We're talking about everything from animal feed and poultry to being one of Southeast Asia's largest egg and surimi producers. And this brilliantly illustrates a key strategy. They literally do not rely on a single source of income. Plus, they hold the master franchise for Family Mart in Malaysia, which has been expanding like wildfire. This diversification, that's their armor against market shocks. Moving on to Section 2, tracking the share price, the 50-day heartbeat. Over a 50-day trading period from late March to June 2026, you can see the share price fluctuating, but steadily, right in this tight little channel between 340 and 400 ringgit Malaysia. This is what we call low volatility. When a stock price moves in small, controlled increments, rather than taking you on a wild, heart-stopping roller coaster ride, it's a huge clue. It tells us investors have a lot of confidence in the company's stability and its intrinsic value. Let's actually break down that timeline so we can see the narrative here. On April 8th, the stock peaked near $4.00, totally driven by positive market sentiment. Then, bam, we see a sharp, temporary dip down to 340 on May 28th. But here is the crazy part, and what you should really take away from this. The recovery was unbelievably fast. Within just days, investors saw that lower price as a prime buying opportunity, and by June 11th, the stock had totally stabilized around 374. That kind of rapid bounce back is just a pure demonstration of market resilience. All right, Section 3, decoding the financial ratios. Time to look under the hood. We're going to start with a super foundational metric, return on equity, or ROE. This simply measures a company's ability to generate profit efficiently from shareholders' equity. To put that in plain English for you as an investor, how well is management actually turning your hard-earned invested money into tangible profit? Well, the answer for QL Resources in 2025 is 13.98%. And actually, that's a really solid number. It proves the company is highly efficient at using shareholder funds to maintain a great level of profitability. It shows management isn't just sitting on capital, they're actively putting it to work to generate a near 14% return internally. Next up is the price-to-earnings, or PE ratio. This is a classic valuation tool that shows how much investors are willing to pay for just one unit of a company's earnings. I want you to ask yourself, would you ever pay a premium price for a company's earnings? Usually, you only do that if you're absolutely certain the future is bright. And look at this. We see a pretty high PE ratio of 31.08 times. Investors are literally willing to pay 31 times the company's earnings just to hold this stock. Why? Because they view this agri-food business as incredibly safe. It's a stable industry, so investors are essentially paying a premium for peace of mind. Though, keep in mind, it also means the company has to keep growing those earnings to justify that higher price tag. Okay, but what about the cash in your pocket? That brings us to dividend yield, the annual dividend cash return received by shareholders relative to the current market share price. This is the direct cash reward a company pays out to loyal shareholders just for sticking around. Now, you might see 1.47% for 2025 and think, kind of modest compared to some high-yield stocks. But actually, scratch that. This isn't a bad thing at all. It tells a very strategic story. Instead of just handing out huge short-term cash payouts, they're strategically holding onto that cash to rapidly expand dominant, high-growth ventures, like the Family Mart franchise. They're reinvesting to grow bigger and stronger, which builds way more intrinsic value for long-term shareholders over time. Our final ratio here is the debt-to-equity ratio. This measures the relationship between total debt and shareholders' equity. Plain and simple, this is a financial leverage check. We're looking to see, are they relying way too heavily on borrowed money to keep the lights on? At a ratio of 0.66 times, the answer is a resounding no. A number below 1.0 means their debt is comfortably lower than their equity base. This confirms a rock-solid financial foundation. They aren't bogged down by heavy borrowing, which dramatically lowers their financial risk and proves they can easily fund future growth safely. Okay, Section 4, Market and Macro Factors. Let's look at the big picture environment. Obviously, no company exists in a vacuum. They face real-world macro pressures. Inflation is a big one. It drives up the costs of raw materials, animal feed, and labor, which can definitely squeeze profit margins. Higher interest rates can also hurt borrowing costs and consumer purchasing power. But on the flip side, strong GDP growth acts as a massive tailwind. A growing economy fuels steady consumer demand for their essential daily food products and retail services, which absolutely supports their top line. Which brings us to Section 5, the final investment verdict. Built for the long haul. When you put all the pieces of this puzzle together, the analysis points clearly to one conclusion. Resources Berhad is built for the long haul. It's the definition of a defensive, low-risk stock. Because they provide essential everyday goods, things people buy no matter what the economy is doing, and because of that brilliantly diversified business model, they have a natural, built-in shield against market volatility. As the source analysis perfectly nails it, quote, Resources Berhad is chosen as an investment because it offers a stable and resilient business model with lower risk compared to many other sectors, unquote. Its strict Sharia-compliant status, combined with its deep roots in essential consumer goods, makes it an incredibly attractive ethical long-term play. So, I'm going to leave you with this final thought to ponder. In a totally unpredictable economy filled with high-risk assets and constant market noise, does your own financial strategy have room for a resilient, stable, halal giant? Because understanding the anatomy of stocks like this is really step one to building a truly weather-proof portfolio. Thanks for joining me on this explainer, and keep learning.